Guys, welcome back to our channel. Again, this is Herminio, and today I'll be sharing with you my discussions on asset allocation decision. And this topic comes from the book of Brown and Riley, the 10th edition of the investment portfolio management book. Again, by Brown and Riley. So shall we start? Now, if you're new to this channel, if you like our presentation and in support of our channel for us to continue and inspire us to, to share presentations more and more each day, please subscribe, leave your comments for your suggestions so that we can improve more. And if you want some topics for us to discuss, I think you can leave a comment, and yeah, we will try to come up with something better in the future, something new and something that you like much in our future discussions online through YouTube. And again, if you like, click the notification, click the like button, and then also the notification bell for you to get updated all the time. So shall we go? Now, in the asset allocation decision, we will have to understand two terms. Two terms according to Brown and Riley in their book. The first one is the asset allocation term, and in the asset class. Now, remember, in your asset allocation, you have to remember two things where you will have to distribute your wealth. So again, asset allocation is a process of deciding how to distribute your wealth, the investor's wealth, in different areas, in different countries. Plus, you'll have also to identify the different asset classes for investment purposes. So again, geographical location, countries, and then type of assets, the asset classes you have to identify for the purpose of an investment. So again, we will have different goals in investing, but your asset allocation decisions this process will help you to reach your goals, your investment goals in the future. So number two is asset class. It comprises of securities that have similar characteristics, attributes, risk return factor relationships. So again, when we talk about securities, it would refers to bonds, stocks, those that are available in any financial markets. So yeah, securities are just piece of paper that will prove your ownership of a particular stocks, bonds, and so on. So we call this one securities. It's not a security card, but when we hear about the word securities in at least in investment and portfolio management, it refers to kind of assets that are basically traded and invested in financial markets like stocks, bonds, and other forms of cash related I mean monetary forms of assets that are invested in exchanges throughout the world. Second is, once you understood what does it mean by asset classes and then asset allocation, then we will have to think two things. One is insurance, and the second one is cash reserve. In case we want to invest, we will have to consider to be insured, either life or non-life or both of it. So my advice is, we will have to transfer the feeling and the thinking of uncertainties or the risk factor. So other terms for risk are the uncertainties. So for me, one of the most word that is so almost close to an equivalent to the term risk is uncertain. The word uncertain. You are not so sure of the future, so because of that, the feeling of not so sure about the future, that gives us a lot of problem and stress. So we will have to transfer this feeling of uncertainty, this risk factor, to a third party. So we will have an insurance company that will manage all of the rest that we will have to encounter in the future. It will blanket us from massive losses, and it will help us to revive again. So insurance, it could be life. You will have to insure your life, or a car, or non-life forms of insurance. So yes, it will be life or non-life. Again, it is a necessity. Or else, if you do not like to go with a third party, you will have at least save a lot of money that will blanket you in the future when there are so much risk involved. And then the second one is cash reserve. How much cash reserve according to the book? You have at least 6 months of your monthly income. So if you have a monthly income of let's say 100,000 a month, then you will have 600,000 as your cash reserve. Then it is now the time. It is now the best time to proceed in an investment uh, process or an investment journey. So in embarking into a journey of investing your capital, you will go into the different phases of investment cycle. Every baby comes to this world, and then every old guys died. You will go through this cycle. So the first one is accumulation phase, followed by consolidation phase, and then followed by spending and gifting phase. Now, the spending and the gifting phase are sometimes they are so close, and they are together towards when the time when we are at the moment that we are already retired. So going through these phases, you can see there, yeah, you can see on the three phases, you know, the the vertical uh, line shows the net worth there, and then you have the horizontal uh, tells you about the age of the individual. So remember, the net worth is it will be your asset minus your liability. Some the capital, the amount of capital that is left in your pocket after all you pay the liabilities. So that is the net worth. And when you start very young, at the age of 20 to 35, your net worth is just uh, growing. It's not that big, it is small. And you need to grow that along as you improve your position in your company, in your workplace. So basically, when you're at the age of 20 to 35, maybe you will be a simple rank and file. So that's your income also is low. And then also you will, when you maybe grow in the position in the corporate ladder, when you grow, it might be a junior supervisor. So therefore, your net worth there is not that big. Plus, you're accumulating things. So the long term there is your retirement. Of course, you started very young to plan for your retirement. So after graduation, right away in college, then you will have to do it. In children's college needs, this is the best time to prepare for the long term. And then for the short term, many of us really want to build a house and a car, and then and so on. So we accumulated different types of asset, and as we go along, at the age of 35, this is the time that we will have to go for consolidating all of these. And still, our long term goal is the retirement still, and short term for, let's say, vacation, and also our children's college needs. This time we believe that maybe our children are now in high school or in college, so this is the best time to make it short term. So this is consolidation phase, and if you try to look at it, the net worth really grows so fast and so high, and it reached its epic at the age of around 55 to 60. And 60, you're about to retire. And then if you try to look at the net worth, it is now declining down, and your long-term goal will be your estate. Okay, so you will have to make sure that your will and testament are followed, who gets who. So you will have to plan your estate. This is the time where you will have the spending and the gifting phase. Why spending? Because as an old person, you will have to suffer from different diseases, different sicknesses, and it requires medical treatment often than when you are a little younger. So retirement age is also a tired age. You will be always going to the hospital, going back to your doctor each month or each week. At least you can die nicely when you do this. So yeah, so if you have money, at least you are planning to die nicely, so this is the best time. And then gifting phase, because of course if you want the love of your grandchildren and your children, if you want them to go and stay with you, you have to give them something. At least every moment you will go, and you will have to provide them, and people will like you even you are a very old guy. So lifestyle needs, you will have to maintain your good life. good lifestyle. If you are used to having vacations, then at least also you will have to maintain that. So that is why it is a spending phase. At the same time, you will have to provide gifts, then a gifting phase. So these are the phases. Then until you die. So if you try to look at it, the net worth at the age of 35 is almost close to the net worth when you are at 85. So the older you get, the lower your net worth. So I hope you will accumulate more net worth, consolidate more net worth, and acquire more of capital, so that when you retire, you cannot feel the drain or the decline of this capital, and you can still maintain your lifestyle. Then the next one is sorry, you will have to go to the portfolio management process. So after you identified and learn about the investment cycle, that you will really have to go with it. So you will have to identify, number one, for your portfolio management, you will have to identify your policy statement. Then you will have to focus on investors' short-term and long-term needs, familiarity with the capital markets, history, and expectations. So three things. Identify your goals and your needs. Then, of course, familiarity with the capital markets, because if you do not know, how can you create your policy statement and then your expectations for the future? So remember, identify your needs, the market, and your expectation. Then you can design your policy statement. Your policy statement and your portfolio management revolves around this. Then you go to step two, then examine current and projected financial, economic, political, and social conditions. You have to look at the external environment. At least you may conduct SWOT analysis, whether it is favorable to do some investments. And on this part here is um, your focus is to be short term and intermediate. Intermediate terms is maybe around um, 6 to 10 years, and then 11 will be the long term. So you'll have to look at your expected conditions to use in constructing a specific portfolio. So your short-term goals and your intermediate goals is the main factor that towards constructing a specific portfolio. So how much will be the combination of stocks, bonds, and cash or real estate in your portfolio? So this will be the basis. The moment you examine the current and projected external environments, such as financial, economic, political, and social conditions. Number three is implement the plan by constructing the portfolio. Your focus here is to meet the investor's needs at a minimum risk. Remember, you can simply the moment you can meet the investors' needs, then go with it. Consider also the risk factor. Okay, so but again, uh, you must really have to meet the investors' needs, and then just inform them at the amount of risk, whether they can accept or not. If they cannot accept the risk, so of course it is a good signal that you will not. It is a signal that you will not really have to go. So number four is the feedback loop. In the feedback loop, this is the time you can give inputs of what really happened in the portfolio. You monitor and update the needs to your investor, the environmental conditions, the one that we are discussing from number two step, and then evaluate portfolio performance. And after that, we can go back to step three, then step two or one, and then go back to the process. The next is the investment objectives. Actually, there are four according to the book of Brown and Riley. And the first one is capital preservation. Capital preservation and current income are basically the investment objectives of the older, retirees, guys who are towards retirement. So you want to preserve your capital. Why? Why does people retire? Retiring. Those people that are planning to retire, people at their 60s. Why do you want to preserve your capital? Because they do not have chance anymore to recover or earn more income. to replace their losses. So of course they don't want to lose their capital. So their objective is to keep their capital. So many things. There are so many things how to do it. But of course you will have to hide it under your bed. But physical risk may be involved in that one. Your house may get burned. There will be flood, and then it will wash your money, and then someone will steal it, and also uh, problems of you know problems of inflation. That will also reduce the value of your capital, although you did not lose it, but of course the value reduces through inflation. So there's an inflation risk. So again, you will really have to find out ways that or processes, investment actions that will really save your capital or preserve your capital. So I may suggest putting it on CDs or on bonds. Yeah, that will be better because your capital is there, but although the earnings are not that big. Another one is capital appreciation. Yeah, here you want to grow your capital. A good securities are stocks and mutual funds. Yeah, so but stocks is more of high risk compared to bonds or other forms of capital. And yeah, if you want to grow, and young people likes this, fresh graduates, yeah, people that are in their 30s, they want to grow their capital for their retirement. So capital appreciation is an objective fitted for those that are at a younger age. In current income are fitted for those that are older. Again, they cannot afford to lose and they want to maintain their income. So current income are for those that are under 60s, for those that are preparing for retirement or retired individuals. So if you yeah, so bonds is very good with in producing income for those people who are retiring, this fixed amount. Then the total return is like a combination of capital appreciation and current income. So by the way, this is also good with both people in their 60s and those that are people that are in their 20s or 30s. But capital, the total return is again most famous among the young. Yeah, because the young people on their 20s and 30s really have to spend money and spend more for their needs. The needs of the 60s, people in the 60s during their time are just so little compared to the needs of those people that are 30s now and 40s. So remember all of this: capital preservation for the old ones, capital appreciation for the young ones, current income for the old ones, and total return favors with the young ones. Number three, this is the last one. I mean, sorry, it's the seventh slide. And this is second to the last. I thought this is number three to the last. So we have asset allocation decision. Now, when you allocate your asset, you will have to consider three things: risk factor, and also the time horizon, and your goals. Yeah, and then your asset allocation strategy. And again, the longer the time horizon, the more you take on a riskier type of investment. And stocks is the riskiest of all these three. Cash is the less risk compared to bonds. So in the order of risk, we have cash the least, followed by bonds as medium, and then stocks as having a higher risk. So if you are for short term and you don't like so much risk, maybe you will go all for cash. Or if you have a medium or moderate risk factor, then you will go more for bonds, and then for cash, and then a 20% for stocks. That's strategy one. But if you really love risk and you have much time for the future, you are young, then you'll go for strategy five. So those people that are older, they will prefer with those those portfolio with much of a mixture of cash and bonds. But those people that are really go for the long term, the young people really love more for stocks and at least for bonds and cash. So again, remember this asset allocation decision is you consider the risk, the investment goal, the asset allocation strategy, plus the time horizon. And guys, when it comes to investing, age really matters. And the younger and the older people have different ways of doing their asset allocation decision and strategy. So the last one of our presentation is, still there are investment constraints or limits. Even though we are so excited, even we do have so much capital, even we already established our investment management process, and we have the best of available resources, but again there are limits like liquidity needs. There are really times that, we want to buy stocks and bonds, but actually there are times that we do not have so much. We have assets, but it's illiquid, like real assets. But we want to convert it with cash, or I mean, yeah, for bonds and so on. Sometimes it takes a hard time. So real assets are hardest form of asset to be converted to cash, and like stocks and then bonds. But compared to bonds, stocks is easier to be converted to cash. And then second is the investment time horizon. Our life is limited. We could die. We do not have so much the luxury of time to grow our funds. So this will affect really how we make decisions for the future. Then the third one is tax factors. And of course, yeah, sometimes we will be taxed 20, 30%, other countries 40%. So this will affect really our returns. Remember, the highest the return you want, the higher the risk also will that kind of investment will take. So it's the basic principle. The higher the return, the higher the risk, or the higher the risk, the higher the return. You cannot separate the risk and return interplay in the investment cycle. The next is legal and regulatory constraints, and the last one is unique needs and preferences. Of course, sometimes even though you reach your investment goals, but still you are not happy because of some unique needs and preferences. And of course, needs and preferences, if you're married, it is not only for you but also for your children. And I guess this is the end of our presentation. If you have questions, you can put your comments and then subscribe. And of course, don't forget to like and click the notification bell for us to be inspired and to continue publishing quality presentations and good presentations. Have a good day, everyone. Bye-bye. And don't lose hope. God is there. Thank you and have a good